Good morning, everyone, and thank you for the introduction and welcome to the panel. Just as a bit more background, as mentioned, I am the engagement partner of the MasterCard Foundation Fund for Resilience and Prosperity and partner at KPMG East Africa, and we're the fund managers of FRP, as we call it. Just a bit more background about FRP. It's a 7-year program that's a 126 million fund across 20 countries in sub-Saharan Africa. We're working on 4 themes, 3 key themes with the new one that's just been added. The themes are agriculture, climate impact, digital economy, and health. And we're working with moderate to high growth SMEs to basically catalyze, sustain, and scale their growth to create fulfilling and dignified job opportunities for young women and men, which is really at the heart of this program, and especially financially disadvantaged young women and men. And we're doing this through a few interventions. So currently our Agriculture Challenge Fund is live. So the Challenge Fund mechanism provides that early stage financing. We also provide technical assistance for capacity building and mentoring throughout the program, as well as a connect service where we're connecting to investors and providing access to markets. And that's really part of our blended finance approach. I'd like to welcome our panelists and ask each one of you to introduce yourselves and just talk a bit about your experience with blended finance as well. Starting this way.
Hi, so good morning, everyone. I'm Dinesh Srishankar. I'm Group Head for Credit Enhancement Facilities at the Private Infrastructure Development Group, or PIDG. PIDG was set up in 2002. It's funded by a number of governments, namely the UK, Swiss, Swedish, Dutch, Australians, and Canadian governments. And it's been operating on blended finance principles since before blended finance was actually a term. So we're taking our government owners' money and we are deploying it through different financial instruments to mobilize the private sector. So that's the P in PIDG. Everything we do has to be private sector focused. So we have technical assistance grants, which is there to help finance development of frameworks, such as PPP frameworks, everything to facilitate private sector involvement on the continent. We have an equity fund called Infraco Africa, which takes the government funding we have, deploys that on a commercial basis into private sector equity investments alongside private sector investors. So there we're helping projects come to market that wouldn't otherwise be there. We have the Emerging Africa and Asia Infrastructure Fund, which is playing a similar role to Infraco, but on the debt side. So it's taking government funding on its own balance sheet. It's then blending that with private sector debt from people like Allianz. So it's blending at the fund structure level and then lending into private sector projects that require long-term hard currency non-recourse financing. So it's helping plug financing gaps on the debt side and getting these projects to be fully financed. We also have Garanco, which does local currency credit guarantees. So Garanco is taking the government funding. It's not lending it, but it's leveraging it 3 times to issue $3 worth of guarantees for every dollar of investment into it. And then it's taking those guarantees to help mobilize the private sector on the debt side. So it's providing guarantees to banks and bond investors to get them lending local currency into private sector projects. So it's mobilizing private sector debt into private sector equity projects as well. And so you see that's an overview of the different ways where you're trying to use blended finance structures across the group. Thanks.
Thank you.
Thank you, Smita. So I'm Donald Kariuki. I work for Norfund, which is the Norwegian Development Finance Institution. So at Norfund, we have 5 core focus areas. There is renewable energy, financial institutions, there is agribusiness and manufacturing, there is green infrastructure, then there is finally fund-of-fund investments. So I'm in the agribusiness and manufacturing department, which is the only department that actually exclusively focuses on sub-Saharan Africa. So I'll be speaking from the lens of an agribusiness investor in sub-Saharan Africa. So this is a segment in the market that is actually capital deprived, but is also quite critical for food security in the continent. As a result, we're having to find a lot of innovative ways to unlock more capital into the segment. So some of the blended finance structures that we are coming across in this segment is fast loss covers. So a fast loss cover, it seems a lot of the investors in sub-Saharan Africa are actually more concerned about downside risk, so how much they're going to lose more than what they actually are going to get out of an investment. As a result, fast loss covers is something we're seeing a lot within the agribusiness space. And we're also seeing a lot of guarantees to banks to actually unlock capital into agribusiness. So what is happening is the guarantees actually are enticing the banks to lend, which is actually ensuring that agribusiness investments are getting funding at lower cost of capital, which makes them more bankable. Yeah, so this is some of the aspects that I'll be contributing to the discussion.
Thank you.
Hi, so yeah, my name is Thijs van Saal. I'm the CEO of Everest Wealth, and I've got no idea what I'm doing here. All right, so I'm a tourist. I'm enjoying the beer and your great weather that you guys have, and that's about it. But I think all of you that's sitting here knows exactly what this panel is all about. So what we bring to the party is obviously one part of that's experience as fund managers in South Africa, well licensed as well. And of course, we're more from the private sector funding side with more than enough, proven concepts that we've done in the past with governments, directly and indirectly. Agriculture and mining, very successful in Namibia, Mauritius, South Africa itself, Botswana. So Sub-Saharan Africa, we know what we're doing. We don't like problems, we like solutions, and that's what we specialize in a nutshell. So yeah, that's what I'm going to bring to the panel.
Great, and great you're enjoying the beer here
Yes,
from the
brilliant.
wine in South Africa. So.
Hi, I'm Kehinde Aladekoye, the Senior Investment Officer at Backer Fund. We're a small fund compared to all the funds I've heard in the panel here, and our work is quite more granular, but our blended finance structure is actually a small one. We're focused on SMEs in Africa, across three major sectors: agriculture and food security. We do environmental and natural resources, and that's just a fancy way of saying we do restoration and tree planting. And then we also focus on clean energy. In our structure, we've got a technical assistance facility. We have grant capital that we use for investment, patient capital into SMEs. We also have equity, and we have debt. So we have almost everything an SME would be looking for with a funder. But just to also mention, we're still fundraising, so our work to date really has been on the TA part, in the technical assistance part. And what we do in that section really is majorly in two folds. We have the pre-investment side, which is our investment readiness program, and that's got an ecosystem building initiative or mandate actually, where we work with lots of SMEs in the sectors that we focus on, not just for the sake of bringing them into our portfolio, but also to help the ecosystem have more investable companies that are ready to take on external capital. This year alone, we've worked with 3 companies in our TA facility program, and some of them have gone on to raise capital from other capital providers because we're not ready yet, we're still fundraising, and hopefully we'll get a first close in the next few weeks. But that's what we do. On the pre-investment side, we help them get ready for investment, formalize their operations and all that. We'll talk more about that in the panel as we go. But the other side of our TA is actually on the post-investment side, where we have a post-TA facility where we want to provide TA support continuous from the first one, but above and beyond what you normally expect from a traditional VC or PE fund in terms of support for portfolio companies. But that's basically what we do.
Thank you. And I know we'll deep dive a bit further into that, Michael.
Hi everyone, I'm Michael Reiser. I'm a program director in the social finance team of the UBS Optimus Foundation. The UBS Optimus Foundation is a foundation linked to UBS, the bank. And thematically we focus on health, education, and nature carbon solutions. We are doing this with philanthropic money. So we have also, in some cases, we have been raising, for example, last year around 330 million in philanthropic capital, but we are more and more also doing essentially impact investing. We do this in different ways. In some cases, the UBS Optimus Foundation would be deploying capital themselves, which is raised from philanthropists, but also investors through UBS. In some cases, we also work with the bank as a fund manager or external fund managers. We do have, overall the goal, I guess, of this work is just to mobilize more capital really for high impact projects. Maybe I would just mention maybe 3 examples to make this a bit more tangible. We have, for example, the SDG Outcomes Fund. This is a blended finance fund which invests in essentially impact-linked finance transactions. And this is a $100 million blended finance fund where the Optimus Foundation was investing 20 million in first loss capital. And then on the commercial side, we would have some of the UBS clients, but also some of the DFIs investing. Then another example is essentially our work focusing on nature carbon. There, the Optimus Foundation was starting the work with providing some readiness grants to projects in Africa, but also in other places around the globe. And then we moved on from providing this investment readiness grants to also investing with more kind of concessional capital in carbon projects. And we're now at a stage where we can also partner with UBS, the bank, on then building a larger nature carbon facility. The third example I'd like to mention is just quite relevant maybe for some in the room as well, and I know there are some actually which received funding from this facility. This is called the SDG Impact Finance Initiative, or short SIFI. And this initiative is essentially a PPP with the Swiss government, the Luxembourg government, and soon also other governments. And it is providing design funding, for example, for high impact funds which are being developed. It also provides catalytic capital to funds with a high impact and a blended finance element. And it also focuses on building essentially the impact investing ecosystem. But I'll stop there for now.
Thank you. Thank you. And one of the things that we're doing through FRP as well is addressing access to finance barriers that a lot of these SMEs are facing. And one of the things is through the early stage financing as well as connecting to investors as well. And Michael, maybe sticking with you, if we could just deep dive a bit further onto how you're seeing blended finance unlock private investment, and particularly de-risking as well.
So I think the concept of blended finance is quite simple, right? Like using some philanthropic or also public funding to unlock more commercial investment. I think also using some blended finance elements is also quite straightforward, but I think like really getting this mobilizing effect to work is like much more difficult. And so maybe I just try to share like 3 learnings we've had over the time. One is focusing on basically leverage. I think with leverage in blended finance, we basically mean kind of the proportion of commercial capital which is being mobilized compared to the catalytic capital which is being used. And some organizations in the space will be aiming for maximum leverage. And that makes sense, of course, because we have very limited pockets of philanthropic funding available, and we want to mobilize more of this commercial capital. But obviously there is a trade-off between also leverage and being additional. We have seen cases as well where there was quite a high leverage, but then essentially the catalytic capital didn't have like a significant effect on the IRRs, for example, of a fund, such that, for example, the IRR of the fund overall without any blending, and then the commercial tranche of a fund with blending was almost the same. And then essentially it's not adding anything, so we might as well just do it without blend. The second point is one around the use as well of the capital. In many cases, I think like what's interesting is that it goes sometimes. So many of the catalytic capital providers there might be more philanthropic organizations and a bit weaker on the financial DD, but it's essential that also the catalytic capital providers are really doing a deep financial DD as well. Like to understand really like how they can mobilize capital and making sure that what they provide is additional. B, also we've seen with many blended finance transactions that one of the benefits of this catalytic investor is that you have like someone which really champions the transaction and can be maybe a lead investor. But to do that, the organization needs to have credibility as well on the financial side. And then the third point is that we just wanted to see as well that we need to bring in more than just philanthropists. We need to work together with the financial sector, and we need that these blended finance elements all speak to each other. It cannot be done in isolation. So for example, with technical assistance or investment readiness work, the technical assistance needs to correspond also to then the investment capital which is coming in. And that's, I think what's great is that at the UBS Optimus Foundation, because we are sitting between philanthropists and the bank, we think we can really combine this ideally and then design workable blended finance transactions.
Thank you. And one of the things that we're doing as well is an intervention through convening and influencing, working with multiple stakeholders as well and sharing our results. So moving to you, Donald, when you're designing blended finance programs, what stakeholders or what perspective do you have on the stakeholders to be involved from a risk and return perspective?
Thank you, Smita. So from our perspective, we've come to appreciate that there's a multitude of actors that are actually required to make this work. And I think it's a different setup from what you see in different investors in Europe and some of the developed markets in the world. So as a result, you'll actually see a lot of technical assistance department within investor institutions, which is very different from what you see in more developed markets. So I think technical assistance programs is quite important to cover the non-commercial aspects of a project. So speaking from the lens of an agribusiness investor, technical assistance programs are actually necessary for non-commercial aspects, which is like the aggregation of smallholder farmers and also training employees. There's some of this development that is non-commercial but also quite critical for the success of a project. Then we're also seeing a lot of big roles required actually by the multilaterals and the development finance institutions. They bring in, first of all, the know-how, and also they bring in the big ticket sizes. The big ticket sizes actually tend to make some of these projects feasible and also bankable. So that is required there. We also need our local governments buy-in, and they can also come in through guarantees, which make the investors more comfortable and also create some form of expectation on the regulatory environment being more predictable. Yeah, so those are some of the actors that we see. Of course, not to forget the philanthropists who also, and impact investor institutions that bring in financing with lower risk-adjusted return expectations than the private institutions, who tend to want to come in when it's more investor ready. Yeah.
Yeah. Thank you, thank you. And moving on to the catalytic nature of blended finance, what key factors do you see need to be part of that catalytic journey for blended finance?
I think the most important thing and aspect about blended finance, if you listen to the panelists as they've been answering so far, is definitely a key factor that needs to be actually more aggressive, especially in a continent like Africa than compared to Europe or, for instance, the US or whatever. So, but then also to see that it's always skin in the game, and I think that's very important. Okay, when it comes to a roundtable discussion, there's a big pipeline on the table. And then also to complement then everybody that is around the table, whether it's then a foundation, whether it's a government, whether it's private capital, and then to stipulate, okay, but what do we want to create out of this investment? Yes, we want to return, absolutely. That's the first priority. Okay. But secondly, what we want to create is sustainability. We want to create jobs. We want to create tax revenue income. Local government, we want to enhance that wherever we launch the project in. So there's a lot of elements that plays a role without just playing the financing game by doing a due diligence process and to say, what's my risk? Can I maybe invest into this project? Yes, I have a guarantee from this local government, or even from a government's perspective if it's a really big game. Or you can just say, but indirectly I can even get support, for instance, from a government situation. But we're not only going to invest in this local government or in this country, for instance, and creating jobs, creating sustainability, creating tax revenue, etc., but we're also going to now empower the people that is getting impacted directly from this investment, together with the government or local government that we go in cooperation with, to also pull them in. And then also to back your jockey one step further to say, but listen, what is the exit strategy of this plan? How are we going to exit it? Because at some stage, our investment committee that's sitting around here and all this corporate governance that is piling out of here is borrowing and everything is up in there. So we need to say, okay, but how long are we going to be at risk? If there is a risk factor, what is my exit factor going to be from a private equity perspective or private investment perspective? And then also to maybe stipulate, but if it's going to be a government a collaboration, I must be 100% certain that some sort of government pension fund is going to swallow it up within the next 5 to 7 years. Also to make sure that I always have an exit strategy. So it's a big picture that you have to paint and to make sure, listen, this thing boils, but as soon as it gets out, it gets backed. There's programs that complement it, and there's governance that's in there, and then obviously the most important part is the exit.
Yeah, thank you. And you mentioned skin in the game, and that's definitely something we look at as well as part of our Challenge Fund program. So when we give early stage financing, we actually require the SME to provide some sort of matching fund, be it private equity, debt, any cash contribution, and anything in between really, just to make sure it does remain catalytic. So I agree, the skin in the game, and also part of the exit strategy, because even with the kind of funding we're giving, early stage grant funding, it is only for a short period, and there has to be sustainability involved after that, which is why we have the connect function as well, to be able to connect to other investors or lenders or any other types of finance support that the SMEs and participants can get. And one of the things, of course, that impacts them through this funding is potentially currency fluctuations and impacts as well, particularly foreign exchange, and obviously working in Africa. Dinesh, what are some of the learnings you've seen working with local currency?
Thanks, Smita. So, yeah, blended finance is a great methodology, a great tool. It brings affordability to structures. It fills financing gaps. But the sustainable part is really critical, right? And as you said, you've got the end users of blended finance on the continent typically are earning in local currency. So if your debt servicing, for example, from blended finance structures is in hard currency, as the local currency typically depreciates, then it becomes more expensive in hard currency terms to service your debt. And if you've got, a good example is power projects, that cost is passed on to off-takers and then potentially onto the end users. So you're passing this cost on to the public, which is not fantastic. So what are the options available at the moment? Well, the biggest source of domestic local currency financing are the local banks. Now, they are often constrained on the amount they can provide, the tenors they can provide, or even the structures. Project financing, infrastructure financing might be not a commonly used concept there. So I talked about Garanco within the pitch. So Garanco is providing local currency credit guarantees to mobilize debt investors, and that's working really well. But Garanco's only got so much capacity, right? And the infrastructure and the project financing needs are much greater in these markets. So we're trying to take that model a step further and implement a different type of solution where we want to bring solutions as local as possible. So there's a big pool of liquidity in markets that's growing, which is the institutional fund markets, right? And I'm talking about pension funds and insurance funds. They are growing as the economies are developing in these markets. And what they're normally investing in typically are government debt, sometimes real estate, sometimes bank deposits. So their portfolios are heavily concentrated in these areas. And they're not investing in corporate bonds or infrastructure bonds because they're not used to the asset classes. It seems risky, and there's not much options out there. So we want to mobilize this pool of capital because they're the natural providers of long-term local currency. And if you can get them funding the natural users of long-term currency, which are infrastructure projects, then you've got a virtuous circle which is completely onshore. So Garanco's been doing a great job of that. We want to extend it further. So what we've been doing is setting up new guarantee businesses onshore. So we identify the right markets, we develop the new business, we invest equity, we crowd in other private sector local investors into the equity as well. So we're blending at that level as well. And these entities are set up, they're highly rated on a local basis. They provide credit guarantees, for example, to a corporate bond issuance. When they wrap that corporate bonds suddenly becomes a similar rating to government debt. So you show that to a pension fund investor and say, hey, look at this asset. It's the same rating, so the risk is the same. It's a longer tenor, so it helps to match your asset liability mismatch, which is growing importance to them. It diversifies your portfolio, and it might give you a bit of uptick in yield. What's not to like? So they'll buy that. You repeat that again and again. They start to get familiar with the asset class. And so you're developing the capital market. You're making a new route to financing for the local users of financing as well. And we've deployed this to great success in Nigeria with InfraCredit, who are also here and speaking. And so the pension fund market there now is, I'd say, transformed. They've gone from being heavily government debt focused to now they're investing freely in infrastructure. We've also deployed it in Pakistan. We launched in Kenya 2 weeks ago, the Mana Guarantee Company. And so now we're looking to roll this out in other markets across Africa and Asia and to bring local content. So I've got to stress that we're not running these businesses. We're part owners of it, right? We're investors, but they're run by a local executive management team, right, with local knowledge, local expertise. And also what we find is they bring far greater solution-driven mindset that we can, because we're all offshore, right? They know the market, they know their issues, and they're overcoming structural deficiencies that we just don't see. So it's got multiple angles, but it's, again, all going back to blended finance and sustainability.
Yeah, thank you. And interestingly, when we did our market studies across the 20 countries as well in Africa, I think that local content, local driven solutions, which I think a couple of you have spoken about as well, was something that really did come through as well. And moving on to some of the risks and perceived risks, there's often talk about a lot of perception risk and lack of investable projects in Africa. Kahinde, from your perspective and the work you're doing, and you touched on technical assistance, how is that helping bridge that gap?
Yeah, and I love the word he used, perception, right? But for us, really, given our context, we don't think it's a perception issue. We think it's actually very real that finding investable projects in our context is a bit difficult. And I'll give you our context. We deal with SMEs, really small SMEs who are at the early stages. And what you often find is, and credit to these guys are one of the most hardworking, resilient people I know, and very innovative actually, but because they juggle a lot of problems every day, a million issues. Imagine an SME founder who's trying to navigate a rough day that involves 3 trucks being stuck in a flooded road, and then 2 containers being seized somewhere at the airport and all that. And you come to them and say you don't have a board set up, or you don't have your processes formalized, your quality assurance procedure, for example, is not standardized, it's not written down anywhere, you're over-relying on your operations manager, you manufacture cocoa, for example, and chocolate from cocoa, and you only rely on testing, for example. All these things are why people might not want to invest and say, no, this is not ready for investment yet, you need to formalize things. But then these guys are very, very busy navigating all the problems that comes with working or running a business on the continent. So we think these issues are quite real for us, and that's why we have our technical assistance facility where we help these people come up with ways to mitigate all these problems and bridge these gaps that we think investors want to see, things investors want to see in the businesses before they invest. We will help them put them in place. It could be as simple as having them set up a formal board and or helping them formalize the processes and professionalize the businesses. And things like this, we think, go a long way, really, because the people we've worked with this year alone, I mentioned earlier, 23 of them, some of them have gone on to raise capital, and some of them are actually progressing into our process where we want to consider them for investment directly, because now we feel they're ready to be invested in. And that's why we think more of these sort of ecosystem building initiatives are needed in the ecosystem for people who target this sort of sector that we work with, which are the early stage SMEs. They need more of this support, really, at the beginning to be ready for investment capital. And even at the end, there are things you might want to defer to post-investment to help this capacity building continue. And I think such structures are very important, and that's why we have them. And we are actually still looking for more funding to do more of this work in the areas that we currently cover. Right now we have Eastern Africa part, and then we also want to do this in the Sahel and West Africa, Francophone West Africa to be precise, where people don't usually have access to funding or even this sort of TA that can help them prepare to access funding. And that's why we're working on this alongside our investing, which is our primary work, really.
Great, thank you. And how long are you engaging with many of these SMEs? How long is that TA journey?
Yeah, interesting question. So we actually do hands-on work with them for 3 months at the beginning, and then post that 3 months, we continue to support them, do less frequently and less hands-on. But for those who we want to invest in, of course, the relationship continues. But for those who older people would invest in, who know for us, maybe they need something bigger than what we offer, because our ticket size is actually from 50,000 to 500,000 US dollars, so it's really small. But for those sort of people, we continue to work with them. We continue to introduce them to partners in the ecosystem who can help them, especially in the area of impact measurement, for example. We have partners who are quite good historically, and they built this competency over the years with impact measurement. We refer them to those people and say, take this relationship on and continue. But we do, of course, monitor their progress afterwards. Yeah, we do.
Great, thank you. Thank you to the panelists. I think we have time for some questions. If anyone has any questions. Can't see any. No? there's no questions, maybe any parting shots from the panel, starting with Michael.
Yeah. No, I found it very interesting also hearing you talk about your technical assistance programs, and I think this work is needed in many cases, and I think it's even more impactful if it's really linked into kind of specific like investment facilities. We also see, I think, like a lot, because we have we're a foundation, but we're also investing, this generates sometimes a bit of confusion, so we get a lot of different kind of deals across the desk, and I think another reflection is that it's also important then for, I think, the entrepreneurs to really reflect well on what they're actually building. Okay, they want to have impact, they also want to build a sustainable business, but are they just going to be SME? Are they going to be like a venture capital investment? Are they going to be maybe a non-profit and they should rather just change their structure? I think that's maybe also a point which is quite important to figure out then like what type of capital is really the right one for them.
Thank you. Kahinde?
Yeah, I would just say, reacting to that actually, many of the people we work with, we usually just ask them, and you'll be surprised to hear that some SMEs don't actually want to grow too big. They're quite comfortable with a small size. But understanding what they actually need is a very good place to start, and then with that you can actually build a plan with them, or even decide if they're the right fit for you, because of course there are other people who would want to finance that. You've got commercial banks who can give loans to the sorts of businesses who do not want to become big and global. But I think understanding what they need and then providing the right support is a good place to start, really.
Wonderful. Please?
I think just to close it off, I think the biggest problem that Africa has and the easiest solution is infrastructure. And upgrading infrastructure in Africa, I think that will also be immediate, like my colleague on the left, it can be a solution as to then also building the economy, making it easier for SME or upcoming type of entrepreneur or whatever the case might be anywhere in Africa. So I think infrastructure is the biggest problem. But again, governments shouldn't be, soliciting or be fund managers, for instance, and they shouldn't, secure capital. The same with foundations. They should bring the expertise to the table, okay, and then support the private capital or private debt that comes in. But if there's one point as well that can also come in is the retail type of client. The guy that physically, instead of buying, let's say, for instance, a listed stock, why can't you buy and then also be in blended finance as an individual in the market? So there can be also some tools that can be looked at some stage, like for instance a bond, or if it's a Muslim country, it can be a sukuk, for instance, or whatever the case might be, or tokenization in the future, but with some sort of guarantee that's built around it. Because the biggest thing isn't always, the ideas and the SMMEs that needs to be funded, or the entrepreneurs, or the infrastructure that needs to be built. It's always a factor of financing as well. So I also think to privatize this and to get some more money, from that as well, and to create some interesting tools. I think that can also be a big picture for Africa and for the future. I think that should also be looked at.
Thank you. Ronald?
Yeah, so both on the investor side and the entrepreneurial side, from my perspective, there's a requirement to reduce the rigidity so that everyone is quite open to more innovative and creative structures because to attract more capital. I know the different organizations and institutions have different risk tolerance, but for us to be able to mobilize the capital that is required in Africa, then we need to all be open to the creative and innovative structures that might be put on the table. Yeah.
Wonderful. Dinesh?
Thanks. So I think the role of blended finance is to match up the private sector on both ends, right? The providers of finance and the users of finance. And so blended finance often focuses on providing that financing to the end users. But it's also important to remember that you need to achieve movement on the private sector providers as well, so that their capacity being built. So each time new blended finance structures are being provided, there's a little bit less concessionality, there's a little bit less of that, and the private sector is taking more risk because the concessional capital may run out at some point, right? And the private sector, I'm a firm believer, private sector solutions are the way to go, right? You can't rely on blended finance forever. So we should seek to move the market with every single blended finance transaction that's done.
Cool.
Thank you. And to conclude, I think the other thing is that we're talking about sustainable development using blending finance across Africa, but Africa itself is so diverse, and the solutions that are required in the different countries and some of the different regions are also quite different and unique, with some more technical assistance required, some capacity to absorb some of the financing as well, and just taking those country contexts into account as well. But I understand our time is up, so thank you all, thank you for listening, and thank you to the panel for the rich discussion.